IT services Q1 results are out. For the quarter that ended in June, Indian IT majors reported strong revenue growth and demand environment despite larger macroeconomic concerns around inflation and recession in their global markets. What disappointed the street though was the absolute miss in terms of margins and therefore profits. Almost every single company, especially the large caps like Tata Consultancy Services, Infosys, Wipro, HCL, and Tech Mahindra, reported margin contraction led by ballooning employee costs. This includes the cost of replacing the brain drain from high attrition, massive fresher hiring and then training them, subcontracting, and lateral hiring, apart from the travel costs that have returned in full swing. But is this margin pressure here to last? During the first quarter of FY23, Tata Consultancy Services, which still leads the industry's margin performance, missed analyst estimates by almost 240 basis points. HCL Technologies came in at around 17%, again lower than their 18 to 20% guided range. Infosys came in at 20.1%, which is lower than their 21 to 23% guided range. And Wipro and Tech Mahindra reported similar issues. Mind you, these margin errors have been reported despite the best ever deal metrics and revenue growth performance. According to estimates by ET and the analysts that we have been speaking to, the operating margins will take around 6 to 8 quarters to recover. Most of the margin hit came from wage bills. Now, most Indian IT companies have hiked annual wages by 8 to 10% for local employees over the past fiscal year. This came in on a already high salary base as the sector handed out comparatively higher wage increases in the range of 10 to 12% during FY22.
In this quarter, operating margins were not only lower than expectations for IT companies, but companies like Infosys said the metric would hover around the lower end of their guided range, that is 21 to 23%, at least in the near term. But what led to this?
Yeah, I definitely think a little bit off guard is the right word for this, because there was some measures put in place by most service providers to cover wage inflation and attrition, which really hit our industry hard end of last year, particular opening quarter of this year. The reopening after pandemic as well has resulted in a lot more travel expenses that have jumped into play, which has impacted margins. There's also been a fairly aggressive return to offsites and conferences and things as well with the industry. Increase in things like fuel costs have driven up obviously travel costs higher than they were in pre-pandemic levels. The cost of air flights between India, US and Europe have gone up. They're significantly higher, sometimes 30-40% higher than they were, even more than that. And then other types of inflations are hurting us in terms of hardware. For example, it's more expensive now to attain hardware because of supply chain issues, but also raw material shortages, resulting in shortages of manufacturing too. So there's been a double whammy of inflation, travel costs, travel intensity, demand from clients that's driven the travel as well. And then obviously wage inflation's been continuing to spiral.
Now, a lot of the companies have stated that they expect their strong demand environment to tide them through the current scenario. But one begs to question if the demand environment is also translating to better pricing for the companies, especially since they have hired in bulk across technologies and skill sets over the past year and rolled out multiple hikes for their employees. Is that translating to higher revenue in each of those areas?
What we have seen is increase in rates for specific project-based works involving digital skills. Now, this means that this premium pricing is concentrated, it's not widespread. And we don't believe that the rates for these premium skills will go down because of sustained demand. On the other hand, we believe that the managed services pricing will continue to decline, just at a slower rate. Now, what can have a significant impact on pricing is actually a currency fluctuation. The US dollar is now strong against euro, pound, yen, Aussie dollar. So it is causing a weaker top line growth for some service providers who have a strong presence in EMEA or Asia Pacific. Market demand will stay strong, but ISG model indicates 150 to 200 basis point headwinds with foreign exchange. Now, will all these factors delay the decision making for deals? ISG has observed some delay in decision making, but in pockets. And these delays are because of combination of factors, not just inflation, for example. The softer market conditions will definitely increase pricing pressure for traditional generic skills and portfolio of managed services provider.
This means traditional or legacy projects, which are still a bulk of IT services businesses, will continue to face pricing pressure. But this triggers the question whether this is the new normal or is there any room for recovery.
But things are actually becoming more normal now in terms of companies are expected to turn a profit. That's really hit some of the tech sector very hard, particularly startups and software. We're seeing, I think, a slight lowering of intense demand from the pandemic, where a lot of companies have invested a lot of money in their cloud transitions. That's slowing down a bit now. Deal sizes are going down a bit as well. And then in addition to that, we're starting to see the impact of higher interest rates, particularly in the US, which is slowing down inflation. It slows everything down. And as much as we hate interest rates, the fact we've had 14 years of money flying in to invest in stocks and enterprises and housing, it's all slowing down now. It's returning to a normalization, and there needs to be a fairly painful period of high interest rates and control over money supply to slow everything down a bit. So we're in that period. I don't think this means we'll go into some type of full-scale recession. I just think we're in a bit of a normalization period where we'll see attrition slow down a bit. We're going to see wages calm down a bit. Hopefully, energy prices will start to fall as well as the geopolitical situation irons out a bit better as well. So, that's what I think is happening, and it's more of a slowdown in general.
It's good to know that some normalization is around the corner. Analysts also suggest that Indian tech companies are better placed when it comes to benefiting from cost optimization-led demand, as that will mean shift to more offshoring. In fact, some of the companies, the large caps and the mid caps that we have been speaking to, have been suggesting that European clients are seeking to accelerate their projects and deadlines in order to finish more transformation work within the current fiscal before their budgets can be curtailed or impacted in any way by recession concerns for the next year. We also have the benefit of scale from thousands of tech and data science graduates produced by universities every year. In fact, clients are also ready to offshore more of their work if that means faster delivery. Of course, you can read much more about ET's margin analysis on the sector in detail in our Tectonic pages, where analysts have weighed in on their findings. Thank you so much for watching this video. Please like and share if you enjoyed it.